apart from the fact that central banks buying gold are not going to buy gold stocks, when it comes to stock investors, the history or the recent history or the recency bias, if you like, is that the mining companies suck. That's the technical description of what happened.
I want to talk about the gold mining space, hone in on the producers for a moment, because at over $3,000 gold, clearly a lot of these companies are printing cash at this point. How do you approach that trend? Is this just a, hey, buy Barrick, Newmont, Agnico Eagle? Maybe if you're a little adventurous, put some Kinross or something in there and just call it a day, set it and forget it, we're all good? Or is it more complicated than that when examining the big producers in the gold mining space?
uh, I had to jump in on the side point. It's funny that you said Kinross if you're a little bit adventurous. I remember back earlier in my career, when I was first starting out with Doug Casey, I really liked Kinross amongst the majors. It seemed, the big guys, they were all run by a bunch of bean counters, in their boards. And, they didn't recognize opportunity when they saw it. And Kinross was out there, buying in Colombia or Ecuador or Russia, doing all these really adventurous things. But I got to say, Kinross got their posterior handed to them multiple times over my career. Uh, you know, Millions of ounces that weren't there in Tanzania or Russia, forced sales, or look what happened with Fruta del Norte. Holy cow. Right. So, I got to say that experience has shown that there's something to the bean counters. There's a reason why counting the beans matters. So there's something to be said for paying attention to math and doing things right. Not to throw Kinross under the bus entirely, but um, sorry, I got derailed on the Kinross thing. What was the question?
So in today, when so many of these big producers, the environment we
Oh, the
have to
printing money
basically printing
question, right?
cash.
And how do we
Yeah,
pay? Okay, sorry, back
yeah.
with you. Yes. Well, actually, I just posted a chart in that week, the free weekly digest that you mentioned, and I posted this on Twitter. It's very funny. X was showing the gold price going up, really going up, and all-in sustaining cost margin going way up. And the reason why this is important is because, in my view, there's good reason why the gold stocks have underperformed the metal. A lot of people have been whining over the last year or two, like, oh, the gold's up and these stocks aren't doing anything. What's wrong? Gold stocks are broken. I'm done. I am out. Right. But there was a really good reason for the stocks to, cause some concern or trepidation or show me first. And that is how you've interviewed Rick, and I'm sure he said on the show how in the last big bull market, the big producers turned a sevenfold increase in the underlying commodity into a decreasing free cash flow, like an actual decrease of cash flow. It took real skill to do that. He likes to joke, right? So that's the reason, apart from the fact that central banks buying gold are not going to buy gold stocks. When it comes to stock investors, the history or the recent history or the recency bias, if you like, is that the mining companies suck. That's the technical description of what happened. Though sucking is fine when it comes to vacuum cleaners, but we're talking mining stocks. So I was in the view that the miners would have to show that this time they weren't going to flub it. They'd have to show that this time higher metals prices were going to translate to higher margins, or else there's no reason for anybody to give them a shot. I wrote an article a little over a year ago, or about a year ago, about this charts and all that stuff, about how we needed to see the miners deliver. And guess what? A year ago, we got Q1 24 results, and the miners started to deliver, not all equally. And now we're seeing, the chart that I posted shows that margin. And it's really funny. I post this chart of all in sustaining cost margin, like screaming up there with gold, which is what we want to see. And that's my answer to your question, is that the miners are starting to deliver. And guess what? To move too, and not just the majors. So I think the miners are doing what they need to do. That harsh teacher of the market has imposed some discipline, and they're starting to deliver. And I hope, that they won't flub it again. And, because they're off to a good start. And if gold keeps going and they keep delivering, the money printing, the good money printing keeps going, I think we will see, I think we'll see gold stocks as a class do much better. I think you'll see, obviously, the better operators continue to outperform. And I do think that it will trickle down to the mid tiers and maybe even the juniors. I'm not entirely sure about that this time. But takeover candidates, I think it will trickle down because if you don't discover it, you've got to buy it, or else you mine yourself out of business.
Yeah, well, that's a good segue into discussing M&A in the gold space. We've seen that activity pick up in 2024. Gold was the dominant theme when it came to M&A deals in the precious metals and base metals category. According to S&P Global, this is a quote, the gold deals predominantly involve production stage mining companies in Australia and Canada. How do you see the landscape for M&A in the gold space playing out in 2025, and what are the implications for investors and speculators?
Well, I have to be honest with the audience here and say, I've gotten this consistently wrong for an embarrassing length of time. I mean, it is obvious that you have to, as I just said, you have to, if you're not discovering and building new mines, you have to buy the people who have done that, or else you literally mine yourself out of business. It is a self-depleting business. So the M&A has to happen. Doesn't mean it has to happen when some old wolf expects it to. So I've been looking for a wave of M&A for a long time, and it has surprised me how much, like, it finally starts, but it stays consolidated pretty much at the top, or at the, if not at the very top, though that's where it has been. I mean, look at, Barrick, sorry, not Barrick, Newmont, Newcrest, and, Agnico, and, the universe of major producers is now really shrunk down to a couple names. It's kind of like Highlander at the end. Will there only be one? I don't know, but I hope not. That would be, I think, unfortunate. So I do think it has to trickle down, and you're going to see, mid tiers, or particularly, I think, as Rick likes to say, the single asset mid tiers. Those are going to get gobbled up by the larger mid tiers, the ones that are actually making money, doing good things. I think that's going to happen. It has to happen. And then eventually, if the cycle lasts long enough, I do think that trickles down to the juniors. And I don't mean keep the lights on mergers between, two juniors merging with each other type things. I'm talking, a real takeover from a larger company that's going to advance the asset or build the mine and offer the shareholders in the junior a nice premium. Exactly the timing of that, will that happen this year? I'm not sure. It is striking to me how long and how persistently the M&A activity has concentrated at the top of the pyramid, and I don't see how I could, on what basis could I say that's going to change this year? I think it has to at some point, but I don't know that it has to this year. But I do think we're headed in that direction.